Gold has been taking off versus commodities. Silver is hanging on at the 200-week moving average, but gold is really taking off versus other commodities. So we're seeing that the commodity complex is suffering now, and I think this is the signal of an impending recession, which is why commodities are falling. So gold isn't falling along with the commodities, which means that the gold to commodities ratio is rising. We're back at 9. We've only hit 9 once. Gold to commodities is at an all-time high, excluding this little period over here.
Gold and precious metals have performed well over the last few years. Central bank demand, de-dollarization, and other foreign sources of demand pushed gold to break out of its 13-year cup and handle pattern. Risk assets are selling off, including precious metals. But gold is outperforming in real terms. Gold has broken out against commodities and reached a 3.5-year high. Based on recent developments in the gold market, Rafi Farber notes that although gold is rising while other commodities suffer, this divergence signals an impending recession, as a gold-to-commodities ratio is now at an all-time high. Despite a stronger dollar supported by relative U.S. monetary policy divergence, the resilience of gold prices indicates that investors are looking beyond just the U.S. rate market when it comes to gold. In any case, the outlook over the next 12 months is quite positive. A recession should give gold the ammunition to surpass $3,000 and reach $4,000, eventually carrying silver well above $50. In his analysis, Rafi Farber notes a minor short squeeze in the gold market, leading to a price rise as open interest fell. He suggests that if open interest falls to around 450,000, it could signal the market's readiness for the next rally, with additional fuel for price increases. In his assessment, Farber underscores that the recent surge in bank reserves due to market sell-offs highlights underlying financial instability. He anticipates a significant drop in reserves by mid-September 2024, driven by increased issuance of treasury bills, as banks shift funds from reverse repos to take advantage of higher interest rates. As economists and pundits from Wall Street to Washington ponder whether the economy is headed for a recession or not, banks with greater direct exposure to U.S. consumer loans set aside more reserves to reflect expected patterns in the economy. Most banks added to their reserves in the second quarter against the previous quarter by 6% to 62%, while others subtracted from their reserves by as much as 25%. Now, we present the clips of Rafi Farber's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
What's going on in gold and open interest? Well, we have some encouraging developments here. We have what looks like a minor short squeeze, which is able to reset open interest lower while the gold price rises. You can see in the red rectangle here, falling open interest from looks like to be about 570,000, maybe closer to 600,000, whatever that number is exactly, down to about 500,000, 510,000. So we had a closing of about maybe 70,000 contracts as the gold price went from 2350 to about 2470 or something. So this is the definition of a short squeeze: contracts closing out, short positions closing out, and the price rising. It wasn't an insane short squeeze. It wasn't a non-manageable short squeeze, but it was a short squeeze, and it keeps the price supported as open interest resets lower. I want to see this go below or at least at 450,000 before I call the next rally ready in terms of the fuel available. Doesn't mean it would start exactly when we hit 450,000, but a lower open interest means that when the next rally does happen, we will have fuel left for it. And now gold has been taking off versus commodities. Silver is hanging on at the 200-week moving average, but gold is really taking off versus other commodities. So we're seeing that the commodity complex is suffering now, and I think this is the signal of an impending recession, which is why commodities are falling. Gold isn't falling along with the commodities, which means that the gold to commodities ratio is rising. We're back at 9. We've only hit 9 once. If you take this area that's above the 9, right, and just write that off to lockdowns and insane policies for controlling microorganisms or pseudo microorganisms, or let's not use any other bad words. If we just take this out as in a period of especially acute insanity, then the high here is really at 9, and we're at that now. So gold to commodities is at an all-time high, excluding this little period over here, which I think we'll get back to, but not because of anything similar to what happened back then. It will be a monetary crisis instead. And I wanted to talk about bank reserves. I've been waiting for these things to fall below 3 trillion. It doesn't look like it's happening just yet. We had a big rise to almost $200 billion this week. This is the weekly change in bank reserves going back to 2021. And this is the third biggest week in increase in bank reserves since 2021. Right here, what was this? This was the regional bank bailout, which you would expect that would increase bank reserves because he had an enormous bailout of the banking system in March 2023, which is why we had a big influx of reserves from the Fed into the banking system over here. And over here, I don't know what that is. It's July 7th, 2021. I don't know what was happening back then, but this is the third highest since 2021 of influx of bank reserves. Why is that? Well, because we had this huge sell-off on Friday of last week and Monday of this week, and people were freaking out about it, and it was all over the financial mainstream media. And like banks started to insist that the Fed cut rates now. Inter-meeting, there was the rumors of an emergency Fed meeting that Chris texted me about, and I was driving at the time. I didn't know what he was saying, and I got kind of excited. But this is a big influx in bank reserves due to the sell-off. This is going all the way back to 2008. The weekly fluctuations in bank reserves, you can see that we've hit here. If you count here, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we're in the top 12, 13 of weekly changes in bank reserves. There was a lot of panic, and that's why reserves increased. And let's talk about when they are going to fall fast, and that is when reverse repos finally drain out. So I made here an isosceles triangle. You can see here that for 20 months and 15 days, the reverse repos went from 0 to the peak of 2.553 trillion. And I mirror imaged that line here. And if you take the same amount of time, 20 months and 15 days from December 30th, 2022, which is when this peak happened, would take us to September 15th, 2024. It could be a little bit past that, but it's not going to be much past that. And here's why. What causes the reverse repos to fall is mostly treasury bill auctions. Banks take money from the reverse repo facility and they put it into T-bills because they're in a little bit more interest than reverse repos. Reverse repos is 5.3, and I think the treasury bills are like 5.32 up to 5.4, something like that. So they earn a little bit more basis points in treasury bills. So the more treasury bills that are issued, the more money is drained out of reverse.
In the face of his extensive expertise, Rafi Farber discusses the yield curve nearing an uninversion, which he believes signals an impending recession. Farber attributes the prolonged inverted yield curve to the large sums of money previously printed and held in the reverse repo facility. The spread between the 30-year and 2-year yields, which has led to other yield spreads in recent decades, has been uninverted, and the spread between the 10-year and 2-year yields is about to uninvert. The last 3 times this occurred marked the start of gold outperforming the stock market, Fed easing, and lower real interest rates. In the wake of inflation's surge in 2022, the Fed responded by sharply raising the federal funds target interest rate it controls. While designed to slow economic growth to tame inflation, many analysts feared the Fed's actions, which led to higher interest rates across the economy and markets, would create too many economic headwinds, potentially resulting in a recession. Let's get back to the interview.
The yield curve. People have been talking about this, that we are about to uninvert or we're about to normalize. Some people prefer the term normalize. I don't prefer the term normalize. I prefer uninvert because it reminds me of belly buttons moving from innies to outies, which is more entertaining for me. So that's the term I use. I have very specific reasons for the language that I speak, apparently. So we have this yield curve, and it is about to cross above the 0 threshold. We're at 5 basis points. We can see here we're almost touching the 0. And recessions, as you can see here, they happen after the uninversion, after the normalization, usually between 6 to 8 months afterwards. We saw that here. We saw that here. Shortly after the normalization or going into positive territory, that's when we saw the recession take hold. It happened the last 3 times over here, and over here. That's 1989, 2000, and 2008. Now we're about to cross over into positive territory for the first time since June 2022. This is the longest we've had an inverted yield curve ever. And the question that one of my subscribers has asked is, Rafi, why is it that recessions only happen when yield curves uninvert or normalize? And why don't they happen as the yield curve is inverted? Well, I don't have a perfect answer to this question. I have a speculation because I don't always know what's happening exactly in the banking system. But my answer for now is that when the yield curve is below zero, that means banks can't borrow short and lend long, which means they can't create money through the fractional reserve system, which means the money supply falls. When the money supply falls, you start to have signs of an impending recession. And once you have signs of an impending recession, what does the Fed do? It cuts rates. And when it cuts rates, it cuts the short term faster than the long term, and the yield curve starts to uninvert. So the uninversion or the normalization is really a sign of the Fed starting to act, but they're always behind the curve and they never are able to prevent recessions because Keynesian economics never works. And now, why were we able to stay below zero, to stay inverted on the yield curve and have the money supply shrink for so long? Because so much money was printed in the last printing round, and all that money was put into the reverse repo facility. And as it exits that reverse repo facility, that sustains the money supply even when the yield curve is negative. But since the reverse repos are running out now, we cannot sustain this fake economy below the zero on the yield curve for much longer. So the Fed is going to start cutting interest rates and the yield curve is going to start to uninvert or normalize. And we're not going to have a lot of time once that starts until the next recession, which this time I believe will be very severe and will cause the final money printing round, which is what I've been saying since the beginning of the Endgame Investor.
Although precious metals are selling off, their leader, gold, is strengthening in real terms as very bullish fundamentals are approaching. This, if sustained, is a precursor to very strong future performance from the entire sector. Do you believe the current trends in the market indicate a looming recession? And how do you think precious metals will perform in the face of economic uncertainty? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.